Are we in a bear market? More importantly, is this a cause for concern?
Maybe the big market story this week will likely be the Fed central bank set to hold a two-day policy meeting with a decision and a Jay Powell news conference set for Wednesday afternoon. Steve Leisman joins us with a look at whether stock market turmoil could curtail Fed rate hikes. We ask that question a lot, and a lot of people are saying, in hindsight, the market did this. What do you expect? Look at what kind of interest rate environment we're in. It all just makes sense.
So here's the situation. We have this FOMC meeting starting tomorrow, wrapping up on Wednesday. Everybody in the market is on edge because a raise in these rates could have a dramatically negative impact on both stocks and crypto. Everything's a bit complicated, but in this video, guys, we're going to break it down and find out exactly what this means and maybe even answer the question of, are we in a bear market? You'd be interested in what I found. Courtesy of ING, a 50 basis point interest rate hike from the Federal Reserve is widely expected given recent commentary from officials and the fact inflation is well above target and unemployment is just 3.6%. The negative Q1 GDP print will be shrugged off with quantitative tightening also announced. We continue to see the risk skewed towards swifter, more aggressive actions. We will also be looking for the Fed to formally announce quantitative tightening on Wednesday. The minutes to the March meeting showed all participants felt the need to announce the commencement of balance sheet runoff at the coming meeting. Given the doubling of the size of the balance sheet since the last round of quantitative tightening in 2017 through 2019, this would be done at a much faster pace than back then. The minutes suggest participants genuinely agreed that monthly caps of about $60 billion for Treasury securities and about $35 billion for agency MBS would likely be appropriate versus the peak total of $50 billion runoff seen last time around. So what we can prepare for is the federal government to be dumping a whole lot of assets over the next 4 months. This summer, from a federal perspective, is going to be completely different from the previous 2 years where everything was essentially going to the moon. This is further emphasized by a quote that we got from Caprioli Investments. This was kicked out on Twitter last evening. This perspective is very interesting because, as always, guys, it's more than just what's on the surface. Caprioli states, something that isn't being discussed nearly as actively today as it should is the Fed's plan to unload its balance sheet by selling $1 trillion of assets a year into an already fragile market. The FOMC is expected to approve the balance sheet reduction plan this week that will see $60 billion in treasuries and $35 billion in mortgage-backed securities being sold every month. This is a reversal of the last 2 years of quantitative easing, and it's unclear how much of that sell pressure has been priced into the market already. With the S&P 500 at its lows and printing a multi-month distribution pattern, should the Fed confirm this program on Wednesday, it wouldn't be surprising to see some substantial downside volatility. At the same time, current market conditions may urge the Fed to postpone or reduce the magnitude of this sell side program. Like the rate rise program above, the longer balance sheet unloading remains a theme. The longer risk markets will face headwinds. So with that, you may be asking yourself, well, if the Fed is looking to dump $1 trillion worth of assets, if they're looking to sell these assets, who's buying them? Well, if you didn't know, our nation has quite a lot of debt on its books, both within the nation and to other nations. As of July 2021, Japan owns $1.32 trillion in U.S. treasuries, making it the largest foreign holder of national debt. The second largest holder is China, which owns $1.07 trillion of U.S. debt. So the U.S. is looking to dump over $1 trillion worth of assets over the coming months. I find it very funny that that same number is also equal to the amount of debt that they have to some of these nations. Not to say that this is the only reason, but it's simple market dynamics here. If you're selling it, somebody's buying it. Another thing pressing on the markets is inflation, which at this point can just be chalked up to people have lost faith in the US dollar, or they're deciding to go with a completely digital fiat system altogether. This would explain why we saw last year El Salvador make the move to adopt Bitcoin as legal tender, and then as early as last week, the Central African Republic also made Bitcoin legal tender and decided to regulate cryptocurrencies as a form of digital payments. Would also explain why central banks all over the world are also looking to introduce digital monetary systems in the form of central bank digital currencies. Now, according to Brian Armstrong, CEO of Coinbase, he describes inflation as being good for crypto. He states, a high inflation rate for fiat currencies might lead individuals to invest more in digital money because the dollars or euros they place in a savings account are actually losing value over time. Bitcoin and certain other cryptocurrencies like Ether offer investors an alternative. The economics of the Bitcoin market are complex, but there are some features designed into the digital currency that may help it resist inflation. That to me sums up this entire situation. What we have here with this Fed meeting is the beginning of a catalyst that we might not see play out until later this year. We already see that the world is changing, and it's changing from our wallets outward. Being that this market is so new, guys, we are still tied to the traditional market. Oftentimes we see money flowing from stocks to crypto and vice versa. But on top of that, there's a much larger catalyst that we are currently going through that not many people are talking about. I'm referring to the Bitcoin halving cycles. Last week we did a video explaining what the Bitcoin halving is. I made that video for new crypto investors to get an awareness of just where in the timeline they got into the market at. Unfortunately, if you came in last year, you're right in the middle of the halving cycles. You see, every 4 years, Bitcoin goes through the halving. It occurs every 210,000 blocks. But what is often associated with this halving period is halving cycles, which is basically how price action moves in between the halvings. And according to the data
seems to support this hypothesis.
Never argue with the data.
Never argue with the data. But according to the data, ladies and gentlemen, we got some very, very turbulent months to look forward to. Let me explain. These halving cycles are periods in the market where Bitcoin is either in recovery or going through one of two corrections from whatever the all-time high was for the previous cycle. With that, we've seen pretty much sideways movement in 2022, yet big news and developments continue to happen. So I'm thinking, when the technicals don't give you the answer, well, you gotta turn to fundamentals. And fundamentally, Bitcoin is scheduled for another hefty correction. But trust me, there's a caveat to this. According to the trend, Bitcoin's past two bear markets show that the 5 sequences of events over the 1-year bear market are as follows. Number 1, we have a reversal pattern, followed by a 50% decline from the peak or all-time high, a rebound back to 20% from the all-time high, followed by another decline of 70% from the peak. Lastly, we will bottom out at 85% from that all-time high, and then the recovery begins to happen. Now, according to that data, where are we on this timeline? Well, I'm going to show you. In November of 2021, we peaked at 69,000. From there, we have corrected nearly 50% back to around 35K. In March and April, we saw that 20% rebound when we got back up to around 47,000. This means, according to the halving cycles, that that 70% decline, it's what's next. Now, what is 70% decline from $69,000, $70,000 Bitcoin? That could put us in the high 20s. High 20s. Now, one thing that I did state at the beginning of this year is that I don't think we'll ever see a $30,000 Bitcoin again. If that is to be true, then according to the mathematically, that's the stopping point. And if that's the stopping point, then the altcoin market is literally gonna be like a buy one, get one free event. Now, this is not bad news. Not in my opinion, guys. This October will mark 3 years for me in the crypto space. Your boy DigiHustle's going on his junior year in crypto. But what YouTube will see after a couple years is a very particular pattern. When major fundamental advancements are happening for a particular project or for the space in general, there's always another event that goes on alongside of it that appears to be bigger, and that's so you don't see what the other hand is holding. For example, last December, the only thing that people could talk about was either the metaverse or crypto.com essentially taking over the Staples Center. At the same time, however, Bitcoin had its most powerful technical upgrade in 6 years in the form of Taproot. Again, nobody said anything. Essentially, guys, all the data suggests that we are, yes, in fact, in a bear market. However, this is the moment we've been waiting for. Here's my plan over the next few months. According to the data, we know we have one more stiff correction coming our direction. So my advice would be to wait for that correction. We may even see over a period of a couple days or even a couple weeks that markets start to recover. It's green. Everybody's feeling good. Their sentiment from the week before has completely flipped. But keep in mind, markets recover. Okay? The indicators, the prices that we see, they go from red to green based on a daily open and close. So that's why you see certain days where we are all red all day, and then the following day it's green all day, but the prices never really make any difference. That's the recovery period. And a lot of people will be faked out because of that. So again, my plan, I'm waiting for that one more dip because mathematically it's gonna happen. Once it does, the moment we reach the bottom, ladies and gentlemen, that's when you go all the way in. You go all the way in and you do not stop because mathematically by 2024, I don't want a Lambo. I'm gonna tell you that right now. I don't want a Lambo. Me, I'm a Porsche guy, you know, Porsche 911 Turbo, 1992, black on black with the Pirelli tires. That's what I'm looking for. That's what I'm looking for. Now, let me know how you feel, guys. Drop it down in the comments. What's going to be your first purchase as a crypto millionaire, you know? And also let us know how you feel about this FOMC meeting, the current state of things right now as we head into the summer, guys. We're still rolling. Also, if you're looking into what assets you may want to capitalize on after this correction, got that for you right here. First thing I'm going to turn your attention to is our Elite 8 for 2022, guys, our top picks for the year. Also, if you're into Web3, Metaverse gaming tokens, I got that video for you right here too. Projects under $1, and it will probably be even cheaper once we have this correction. But places where you can start, guys, and get this bag really filled. So with all that being said, you know what I'm going to tell you. Have a great day. Have a prosperous day. Most importantly, if that money is digital, so is the hustle. I'll see y'all in the next one.